Good afternoon, everybody. Thank you for joining us today. My name is Adrian Pellegro. I'm one of the senior financial advisors at Acambo Financial Group. And joining me today is Robert McDeasy, who is one of the senior investment managers also at Acambo Financial Group. Hello, Rob. Thank you very much for joining me today. And look, we just wanted to obviously appreciate you spending the time to tune in today, because obviously what we have is at the moment, hate to use the word unprecedented because I know that's been thrown around a lot, but you know, that's definitely the times that we're in. We've just, definitely entered uncharted territory with record low interest rates, hyper volatility on share markets, record stimulus from governments, and just a total unknown world to any of us. So we've really got a combination of factors that are now, really come to the surface. And really for us as investment managers and financial advisors, what we are, hoping to then try and help you do is to navigate just the issues that we're having in terms of both the volatility, but also the record low interest rates that you'd be getting on cash, etc., in your bank account. So really today, Rob and I are looking to, give you a bit of an overview as to where we see things and some of your options moving forward, because there are quite a few out there, but it's all about, I guess, trying to start to work out, well, what's going to be right for yourself. So I'm just going to be bringing up this presentation here. Just give me one moment while I press the right buttons. All right. So that should be on everybody's screen now. So obviously today, it's very general in nature. There's no specific advice, so please don't run off and go and do anything without consulting a professional. Really, as I said today, is to be more informative and to really start to get the mind ticking as to, some of the options that may be out there for you. So first and foremost, a bit about us. For those of you that don't know us, Acambo Financial Group's been running for about 13 years now. So we're a nationally based business, and really our main focus is to assist accounting firms and their clients. And as you could have seen in the earlier slides, I've got a few joining us today. There's SC Accounting, so thank you, Mark and Steve. There's Arrow and Quill, and there's also Suntax Accounting in summary. So there's a few other businesses as well that we definitely do work with. We've got over 1,200 clients at the moment, and we now manage over $1 billion in money. So definitely not a small business, and definitely one that has the resources to assist our clients moving forward. And then there is unfortunately my ugly mug, and Robert's better looking more so. Now, our agenda today, as I mentioned, the two key things that we want to be addressing: low interest rates and heightened uncertainty in the sense of the volatility that's been happening in the market. So we really want to see, well, where can we start to find some income in this environment, and how can we reduce the roller coaster in terms of our personal portfolios, so that we could have more security moving forward. I think at the end of the day, that's really what we as advisors are here to help you achieve, is more peace of mind and the ability to sleep well at night. I'm going to throw over to Rob now. He's going to run through a few things in terms of the current state of play in regards to the interest rate. So Rob, I'll let you take over and take things from there.
Thank you very much, Adrian. And this chart tells a lot, and it's probably not a surprise to anybody here. There's a number of reasons why interest rates are so low and have gone lower recently. So as you can see, this is back from prior to year 2000. So the trend has been from higher interest rates to lower interest rates over time. And what the impact of this is twofold. Firstly, savers are getting penalised in a way. So essentially we call this the risk-free rate. What can I get for my money with very little or no risk? And what does that mean for your investments going forward? And then we look at the Australian situation. We think to ourselves, well, that's pretty low. It's pretty close to zero. There is talk of negative interest rates, although the Reserve Bank of Australia continually tells us that they won't be going down that path. But the reality is that these interest rates, or low interest rates, are here for a while, considering the uncertainty that we all understand has occurred post the COVID-19 world. If you can flick to the next slide, please, Adrian. And the point of this is to see, well, it's not just Australia that this is occurring, and this is a global phenomenon. The US, which up until a few months ago was the beacon of growth for developed countries. You saw their interest rates rise initially, and you can see that rising from 2015 onwards on improved economic conditions. But similar to us, they're now back close to the zero interest rate environment. So if we're looking for risk-free interest on our savings, well, where do we go? Do we go to Europe? And if you go to the next slide, the answer is clearly no. And in case you're wondering if they're typos, they are not typos, they are negative interest rates. And if you look at the top one, for example, Germany, the largest economy in Europe, that gives you an indication of the low interest rates to negative interest rates that they have there. So for the benefit of investing with the German government for 10 years, if you want to give them your money, they'll give you a negative interest rate over a 10-year period, which is staggering historically. We are, I mean, I've seen the estimates of where we are today compared to over 100, 200, 300 years, and there's a lot of estimates saying that we are at the lowest point interest rate levels we've ever had. So, yeah, there's no place to hide effectively from Australia to the US to Europe. All these developed countries have negative interest rates, and I could throw in Japan there as well. We've got negative interest rates. So this is the reality that you have as an investor, as a saver, as a person who's worked their whole life to save some money. So for us today, hopefully we'll highlight that and then give you some ideas on where you can earn some sort of return on your money. And this is the real world. The reason we like to show this is the real world. This is you going to your bank and saying, oh, I have X amount that I'd like to invest into a term deposit. What does that look like? So essentially you're getting 1.1, 1.2% for a term deposit at the moment. And what is really interesting here is if you look from the 180 days to the 360, 730 days, they're actually getting rates similar or a little bit less than what you're getting for a shorter duration term deposit. Now that's not normal. Normally you invest for a longer period and you should get an increasing interest rate. That's how it normally works. But what this is telling you is that the markets, the money markets, don't expect interest rates to be rising at least within the next 2 to 3 years. So that leaves you with the situation as the saver, as the investor, thinking, well, where do I get my returns in this environment? But I think Adrian here will give some good insights. Adrian has more contact with people on the ground as clients. So I'd be interested to see what your clients are telling you, Adrian, when they do go to the bank and say, well, you know, I was getting 2% or 3% before, now I'm getting this. What else can I do? But can you give us some insight with regard to your clients and their feedback?
Yeah, look, Rob, you know, a few years ago it was pretty easy for most people out there, and I guess more so for our you know, retiree clients who obviously have built up the cash in the bank and could at least you know, put a decent amount in NAB or ANZ or wherever it might be and get 4-5% return, and you know, it's a nice risk-free rate then and there. And you know, 4-5% on a decent sum of money adds up to, you know, the ability to fund somewhat of a standard lifestyle. Now the rates have just been coming down, and you know, now we're at 0.25%, and as we can see on this screen, you know, it basically translates to 1.5% if you're lucky. And the thing is, this is not just for, you know, a couple of months or the year and something that we'll just have to kind of, you know, grit our teeth and bear through. This is going to be, you know, for 2, 3, 4, 5+ years. You know, this is what the charts are telling us, and everything that the economy has been doing is pointing to lower for longer interest rates. So it really can't be about just us sitting on the sidelines for a tiny bit. We really need to revamp our investment strategies for the medium to longer term, because, as I said, this isn't going to be an overnight sensation. Just, I guess, in terms of that, we then start to think about, okay, well, if I can't keep cash in the bank because it's really not paying me anything. In fact, you know, inflation's running just as high, if not higher. So our real, I guess, value of money is going down. What are our other options? And I think this is just a nice graph to really highlight, you know, the different types of investment classes or the asset classes out there, but also their what we call the risk return ratio in that respect. So you can see on the bottom left with cash, it's the lowest return, but obviously the lowest risk as well. Then you start to look at term deposits, and then if I just skip to the other side of the graph there, you can see that property and equities lie on the higher risk, but also higher expected return. So in the middle though, so you can see a lot there is highlighted in red. Those we see are the, I guess, middle of the way, middle band type of risk return assets that you can start to look at, but also are assets that, 9 out of 10, I guess, mum and dads out there or just investors outside of the financial world don't know about or have heard of, but really just don't know what they're about and what their features are, what their risks are, and I guess what their return perspective is. So today, what we just want to do is to, I guess, help you get a bit more of an understanding of that. And I think Rob would probably be best placed to start to shed a bit of light as to some of those things that are highlighted in red. So Rob, you might just give a bit more of an idea as to a couple of those things we can see.
Yeah, absolutely. I think you make a very good point there, Adrian. It's the reality is we're living in a world now pre-COVID-19. Inflation has pulled back in the last few months, but pre-COVID-19, we were running at an inflation rate of around 1.9%. The actual last quarter was 2.2% in Australia. So it has pulled back from there, about 0.3% in the last quarter because of COVID-19. But what that highlights is when you start looking at that compared to your term deposit rates, your cash rates, you actually are getting a negative real return on your money in that type of environment. And this essentially is the central banks saying to you that you need to take more risk to get a real return, whether you like it or not. This is the world that we live in at the moment. What a lot of people seem to think is, well, equities are too volatile. I saw the market drop X amount recently. I can't handle that volatility. And what we hopefully show you today is that you don't have to go from cash into Facebook or Apple or Commonwealth Bank shares. There is a big fat middle part there that is less risk and gives you better returns than cash would. And this is essentially the credit markets. So a lot of people are used to, you buy a property, you buy equity. So essentially you buy a property, you own the risk underlying of that asset. You buy equities or shares in companies, you are buying that company, its assets, liabilities, any upside you get. So essentially what you should get for property and equities is a lot higher return over a medium to long-term period because you're taking more risk. So that doesn't necessarily mean you have to take that much risk, because with risk comes volatility. Excuse me. So then you look at the other end of the investment spectrum, which is credit. And credit is essentially you're going on the other side. You're saying that I am lending to a company, I am lending to a government, I am lending to could be private credit, as an example. And so by lending, and you being the person lending to these companies, you go up the corporate structure. And what that means essentially is, let's just say in the unfortunate event of anything going broke, or their revenues dropping, for example, you get paid first. And because you get paid first, that means the risk drops. And in certain circumstances, a lot of these debt instruments, they must pay debt holders before they pay equity holders, and absolutely in the worst case scenario, which doesn't necessarily happen very often, but the worst case scenario is that you get paid ahead of equity holders. So the equity holder, this is why shares, you should expect a higher return over being a credit holder, because as the credit holder, you have first rights on revenues, you have first rights on assets. So there is a part there from secured debt all the way to hybrid. So secured debt, essentially being you are higher up in the structure, you get paid first. Now, if you're going to take that type of debt, then obviously you get a lower rate of return. If you're going to go to subordinated debt, which means that you are second or third in the queue, for example, for simplicity's sake, you get a higher rate of return, but you're taking more risk. The point we want to highlight here is that risk doesn't mean going from 0 to 100, and 0 to 100 is cash to equities. There is a good return to be made from the credit markets, and that is often you'll hear the term bonds, you'll hear the term fixed income, and this is the part of the market which Australians compared to the rest of the world are underinvested in. And this is the part that you may wish to consider when it comes to your own investments, and you're thinking, well, I don't want to take too much risk. This is the part of the market that is worth having a look at. The reality is, as I said before, though, that we are in a world where the central banks of the world are making us go up that risk curve to get the appropriate rate of return that we need to maintain lifestyles and to get and to accumulate wealth, depending on where you are in life. So until interest rates start rising again, whenever that may be, and it doesn't look like that in the short to medium term at least, they are basically saying you need to go up that risk curve. But everyone has a different risk profile. Everyone has a different return requirement. So part of what we do is trying to match up that risk profile and how much risk and volatility with your needs, and essentially saying, well, the least amount of risk you can take to get the return you need is X. And that's a big part of what somebody like Adrian would do, or a financial professional should do, to assist you in your forward planning. Could you go to the next slide, please, Adrian? And then the other thing too, I think this is really important to highlight, is as the volatility, as you all know, everyone would have read the news and seen it. The Australian stock market, from its high on February 20th to its low on March 23rd, dropped 39%. Now that is an extraordinary amount, and the quickest fall from a high in history. So we're talking about 100 years. So out of that, though, does come a lot of opportunity. So the way we will manage it from our end, and this is I guess the benefit of active management, is we adjust our cash levels. So number one barometer for all investments should be, how much cash do I have versus, and cash is being the most defensive asset, versus how much growth assets do I have, which tend to become more volatile in these times. And that should be a barometer of where you're at, what your risk profile is, but also from my perspective as an investment manager, where we see markets and how high we see risks. We think growth is great. We think the world's a great place. The cash levels aren't very high. In fact, you're pretty close to fully invested. If we think the world's shifted, then you need to have the ability to be very nimble and move those cash levels quite aggressively and quite quickly, depending on the changes. So as an example, come February 20th, by March, we were close to fully invested. The world was looking like a pretty good place, and our actual growth was picking up. Within about a couple of weeks, we went from a very growth-orientated stance to a very defensive stance with cash levels above 30%. Now that protected clients on the way down. Now this is why cash levels are a great barometer, but also a very good tool for controlling risk. Then what happens is, and this is where we are today, so you start going, well, things are starting to normalise. Economic data, while it's not great, is getting better. So it's gone from terrible to bad. Now you go, well, that's not good enough for me to get confidence. The reality is the market starts pricing in a improvement in the economy, and a lot of hard hit stocks. So for example, we had stocks in our market that dropped 60 to 70%. The overall market dropped 40, but certain stocks dropped 60 to 70%. They're the more cyclical stocks that are more exposed to the economy, and they started showing good value. Now, when you get more confidence of things being less bad, these kind of stocks start to outperform. So to give you an indication, the market dropped 39%, and it's off its low. And since March 23rd, it's appreciated 33%. So that highlights the opportunities there are within portfolios, and I guess advocates to a degree some professional management with regard to your funds, because like everybody, it gets quite emotive at the bottom, and the worst thing people can do, in my experience, is to react emotionally to a volatility market. That really pays, particularly when you should be looking at your finances over a long period. And then the other point you need to look at is tactical asset allocation. And what that means is defensive assets, so more bonds and cash, versus growth, property and equities, for example. How do you mix those? How quickly can you change that? And that is really important, because you don't want to suffer the entire loss, and then it takes you a while to recover that over a long period. You're going to be able to be tactical, change your tactics on the short term until the smoke clears to a degree, and then start investing. That way you protect yourself on the downside. So when you start picking up with the markets and the economy, you are starting from a higher base. And if you could just go to the next slide, please, Adrian. Two aspects which are really important, and the first one I think I want to highlight is liquidity. So a lot of you, I'm not sure what your experience is with investing, but liquidity essentially is the ability for you to get out when you need to. Can I sell something because I think the world's turned? Can I sell something because I need my money really quickly for lifestyle or whatever reason that may be? So that's really important. With the way we manage money, every asset that we have is liquid. Essentially, we can get out of 85% of our holdings within 2 days have cash, and the remainder within a couple of weeks. That is a very important factor to look at when you're looking at your investments, because when the world goes volatile, all of a sudden you start realizing not every asset class is easy to get money out of. Some of you may have seen in the media recently some of what they term unlisted assets. So assets that aren't on markets and are not very easy to get out of. Now, if you want to redeem your funds at that time, or you want to be tactical with them, you essentially can't be. You're locked in for that period. So that's a feature that we think is extremely important. Our company was born out of the GFC, and I can recall sitting there talking to clients who want to pull money out of a managed fund, for example, and they've been frozen. We've had certain examples of that occurring in some industry funds recently, and some other funds, and it just highlights how important things are. When things are going well, not so important. When things aren't going well, it's really important to be able to access your money for tactical shifts, but also you may need that money. And again, active management. And I think active management in this time of volatility becomes very important, because the reality is we're not going to have all sectors improve at the same time. We're not going to have all asset classes improve at the same time, and then you need to have the skill to be able to say, well, which sectors, which companies are going to outperform at different parts of the business cycle. For example, if you're buying the entire Australian market through an ETF, for example, and this is not against ETFs, but just to highlight it, is you're also getting a lot of companies which are not going to either survive or thrive for at least a year or two. So you think to yourself, well, why do I hold that particular company? Well, that's the way we look at it anyway. The reality is you want to invest in resilient businesses, and also businesses that will benefit from any uptick. So that will highlight some of the, hopefully some of the strengths of being able to be active and being able to be nimble, and then the ability to access that money and those investments at a time that you need to do it, and that generally occurs when there's a lot of volatility around. Just to the next slide, if you could, Adrian.
Just one moment there, got a bit of an issue with it.
Yeah, sure. I thought it might have just been me. But while we're waiting for that to come up, I just think they're really two important tenets to remember when you're investing. The reality is, in bull markets, or when things are going really well, it's easy to become complacent with those particular aspects. But like I said, we've built a system which is one that very much focuses on the ability to be liquid and nimble. So we thought we'd give you a couple of examples, and again, these are not selling points necessarily, but just give you examples of the type of portfolios, the type of assets, and what type of returns you can get. So the first one's our fixed income portfolio. So we're talking about that fat part of the credit markets. This is what this is invested in. So we have from really low risk credit to a slightly higher risk credit. So diversification allows us to achieve returns, and you can see what we aim with this portfolio is 2.5% above the cash rate. Cash rate currently is 0.25. So our benchmark, and what we say we want to get better than for our clients, is 2.75 in the current environment. So 2019 was a very good year for credit, and a lot of that has to do with those continually dropping interest rates. That's quite positive for fixed income and bonds, because as the yield or as the income drops, your actual price of your of your asset increases. So 2019 gives you an indication of the returns you can get from this part of the portfolio. Now, there is a level of volatility above cash, but in general, this is quite a benign, low volatility portfolio. It doesn't move around very much. We had a situation in March, which was the most volatile period we've had since the GFC. It was actually more volatile, and it was, and in that instance, the portfolio was down around 2%. Yep. So that gives you an indication compared to equity market, which is down 40%, that this is a lot less volatile. You can see you get a lot better return.
Yeah. Sorry, Rob, just quickly there, just, you know, like all assets out there, they're not all created equal. Although there's equities, and then there's equities within the equities, and in this case with the hybrids, there is you know, total different extremes as to what type of hybrids or debt securities that you do purchase, and it all comes down to the strength of the businesses that you buy. Obviously, if they're stronger businesses who are going to be much more reliant as to repaying their bills, then obviously they're going to be more secure in terms of your investment there. And that you can see is a bit of a theme there through, you know, what we do look at. We're not looking for the junk stocks that you know, are very highly leveraged and, you know, are on the, I guess, on the brink of collapse or anything like that. These are the big businesses like the ANZs, the NABs, Sydney Airports, etc. That do obviously have a lot backing them and do have the ability to repay their debts to you. So this is a great thing, because now you're turning the tables, I guess, on the banks in this example. Instead of borrowing money from them, then they're now borrowing money from you. So instead of putting money in the cash account and getting the 1%, you can get into these hybrids. And I would say, you know, sleep very well at night knowing that they're going to keep paying you the 4 or 5% or whatever it is, you know, each quarter, as opposed to you know, as I said, keeping it in the cash account there. So it's things to keep in mind, and same with the equities as well. There's, you know, investments like a BHP, but then there's also investments like a penny stock in the mining sector. There's total different extremes within those asset classes, and it's about then weeding out, well, who are the ones that we actually want to put our money with.
And that's probably a good segue to the next slide, Adrian, with regard to, if you do want a little bit more risk, you want a little bit more income, but also more potential returns, we also run an equity income portfolio. Like the name says, this is shares. So we invest in shares, generally mature businesses that have been around for a long time, with a history of paying strong dividends over a long period. And a lot of those names there you would recognise. It's not just Australia, although we have a bias to Australia because the franking credits that we have in Australia. But these businesses have histories of paying strong dividends, have strong balance sheets. And you can see from that too, they are also more volatile, but you can see the returns compared to the fixed income. It's a higher return. You can expect more volatility within that, but by the same token, over a long period, because of that volatility and higher risk, you should also expect a higher income plus total return when you take that additional. But that, we just wanted to highlight those two portfolios because we are focusing on income, and hopefully that gives you a bit of a feel for the opportunities or what type of asset classes you can tap into or invest in to get what may be more appropriate income and total returns.
Rob, you just want to quickly run over this one here. I'm just conscious of time there. You want to just give a quick overview as to the asset allocations and I guess the tactical allocations that you were touching on earlier.
Yeah, sure. And this is just to hopefully highlight what we have is a strategic asset allocation. Now, what dictates your asset allocation is your own personal needs. That's when you talk to your advisor. They do an assessment of what your financial needs are, what your appetite for risk is, and so forth. And then they come up with a mix of different assets that will achieve your long-term goals, but also doing it for the least amount of risk. What we're trying to show here is what we have a strategic asset allocation, and what that is our long-term view. This is what you should be investing in for the long term. Now, as an investment team, myself and my team, what we do is, depending on the economic situation at the time, we shift all of those defensive and growth assets depending on the situation. Now, for example, the example I gave earlier was we went into a very defensive stance at the beginning of March. and we went more into cash and fixed income assets. Whereas as you get more confident, and as we have become more confident, you start expanding your growth at the expense of your defensive assets. Over time, two things: this should protect your capital on the downside and give you incremental returns on the upside over a long period of time. And these period of time we always consider to be a minimum of 3 to 5 years is a fair time to assess your asset allocation and whether or not it's doing a good job for you. So just quickly, what are the big themes in the market? Well, interest rates, as we've said, essentially that's what prices all assets globally. So you have a risk-free rate and you have an expected return above that risk-free rate. Interest rates are low. That generally means that eventually when this settles down and what our economies settle down, we're going to go into an environment where interest rates are lower than when we first entered it, and they were already at historically low rates. That means that you will not get the appropriate return, most likely, from cash products. So consider what alternatives you have. Demographic changes are massive, and that goes from which sectors you invest in, which countries you invest in, what parts of the world. We have the benefit of being able to invest globally. So for growth, you look at countries, places like Asia and the Middle East, which have the demographic tailwind over a long period, versus other more developed countries, which have an aging population. Both of those create opportunities within them. Technology, we're of the belief that if you aren't adopting to new technologies, doesn't matter what industry you're in, and we obviously invest in tech companies themselves, the facilitators, but any industry who's not adopting will not survive and will not thrive compared to other parts of the, I guess, compared to their competitors. Uncertainty can create opportunity. Like I said, volatility creates opportunity. You can get really mispriced great assets when volatility occurs, but also uncertainty can mean things such as asset classes such as gold can provide a lot of insurance in these uncertain times. And obviously, COVID-19 duration. Do we find vaccine? Has it changed human behaviour from your consumer spending all the way to how you work and how you socialise? There are all massive impacts that we're starting to come to a grip with, and we'll obviously have hopefully more progress on the vaccine side anyway, sooner rather than later. But this is going to influence the way we spend, act, socialise for at least the next couple of years, we feel. I'll pass this bit over to you. You're the expert in this area, Adrian.
Thanks, Rob. Appreciate that. Look, just quickly from my end, and I guess just to give you a bit more of an idea, especially for those who have never spoken to a financial advisor and gone through the journey with them, this really is just I guess a nice overview as to how things progress and what we talk about in terms of your situation. How do we get you from your point A to what is your point B? Really, for us at the end of the day, and more so from my end of the business as advisory, it's the first and foremost step is discovery, and obviously that's an ongoing thing. But really, for us, it's to really understand where you're at now, but more importantly, where you want to be. What are the goals? What are the objectives? And what do we need to then do to really get you there? Some people need to make drastic overhauls. Some need to make minor tweaks. But really, for us, it's about guiding the ship in the right direction. And as Rob mentioned before, it's about getting you there with the least amount of risk possible. It's amazing how much risk people are taking out there in their portfolios when they just purely don't need to. And we've seen that time and time again. I think the simplest example are those that have just the absolute I guess wrongly structured investment pieces, and they're on the brink of retirement. And then things like the GFC, or in this case COVID-19, come along obviously out of left field and totally throw them off their trajectory. So what we're here to do is to really make sure that we are protecting your circumstances as much as possible from external forces. We don't want to have Donald Trump or COVID-19 or anything like that ruining your personal circumstances. So we need to mitigate it as much as possible. I have this priority focus, wherever I go, and I show this to all of the clients that I speak with, and constantly even pull it out for clients that work with me, because what we obviously do is when we do sit with people, we get a lot that, you know, want to talk about specific stocks. Oh, I've got BHP, should I hold, should I sell, should I do this, should I do that? Oh, what about this or that particular investment? Should I buy another property? Is it, you know, should I go for yield, this and this and that? Those are all important questions, but it's what we see is kind of the last piece of the puzzle there. All right, all the specific stocks and specific investments, that they are what we see at the bottom there as the solution. What we need to do is to take 2 steps back and look at first and foremost your strategy. You know, are there debts? What's your super like? Should you be investing? Should you be paying down debt? You know, what's your risk management plan? You know, what's your retirement plan, i.e. how many years away is that, etc. Those are the types of things that we need to start talking about first, because that's more the high level things that we then filter down to the more specific and yes, very important questions as to, you know, where we invest, etc. So really, and I'm just going to quickly jump back to this screen here. My role as an advisor is to really start, you know, from the investment side of things once we work out strategy, but then once we look at the investment, it's to help you get the right mix of all these different asset classes that are going to suit your needs. Whereas Rob, what he'll actually be doing is he'll be helping to choose the specific investments within those asset classes. So he'll choose the right equities that are going to give you the right dividends or the right growth. You know, he's going to look at the property structures and look at, okay, once again, well, which are the right ones for you? The hybrids, the cash, etc. It's all about those specifics. But then for me, it's to help you get that put all together to then suit your goals moving forward. So I hope that gives you a really good idea and a starting point to obviously all the issues that we're coming across right now. There are so many things to tackle, and basically the book has gone out the window in terms of how we invest and how we you know, manage our money and our goals moving forward. So if you do have any questions, by all means, please feel free to give me a call. You've got my direct mobile that's come up on the screen there, my email as well. Or else, by all means, please go straight to your accountant there, speak to the accountant that you work with, have a chat to them, and they can definitely set up a time and to point you in the right direction to speak with us or what you need to do to get things sorted. Now, I did just quickly see a question come through, and a question that we get a million and one times, and Rob, I know the answer. Rob, do you want to answer this for one of the attendees here, talking about just basically whether or not we're going to be revisiting the lows that we've seen? You know, what kind of probability do you see in that, considering what we have at hand?
Well, just to do it as quickly as possible, do we see it as a possibility? Yes. Do we think it's a high possibility? Less so. And the reason for that is not that we think that the world is in a great place, but rather that we think that the reaction from governments and central banks has been phenomenal. And by that I mean that we've seen central banks and governments spending already close to double what they have in the GFC. So in the midst of the GFC, and they did it a lot quicker. So it stopped the rot and the financial system going into a meltdown because of that massive liquidity. And we're talking about $8 to $10 trillion already committed into the global economy. Extraordinary stimulus. Now that doesn't guarantee it, because there is the uncertainty with regard to the virus itself re-emerging and how does that look. But on probability, we think that we're most likely we've seen the lows back in March, and that doesn't necessarily mean we don't see volatility from here on. We just think that the worst of it may be over. And again, don't forget that, as I highlighted before, we're in an environment where, you know, there's not many alternatives to get the returns that you need, and any signs of stabilisation in economies will see. We think more money coming into both credit and equities, but of course, yeah, it is a possibility. We just don't think it's a very high probability based on the reactions of governments and central banks.
Perfect. Thank you, Rob, and thank you all for your time once again. I really hope that you just got something out of this today, and as I said, by all means, please don't hesitate to reach out to ask questions more so about your personal circumstances and queries. We're more than happy to have a chat. Otherwise, take care, and we'll speak to you soon.
Thank you.